Today is Monday, January 26th, 2026. You're checking your portfolio right now. Silver positions up 15%, maybe 20%. You feel smart. And while you're feeling smart, the plumbing underneath that price is seizing. Most people never see this coming, not because the data isn't there, because at $109, the data looks like you're winning. August 1971, the gold window closes. Markets rally for months. September 2008, Lehman holds $600 billion in assets. The system is liquid. The VIX is calm. January 2026, silver breaks $109 per ounce. Analysts call it a safe haven surge. Investors call it momentum. Nobody calls it what it actually is, a structural warning. Stop checking your gains for a second, because what's happening right now in the silver market isn't a rally, it's a countdown. The price is moving, but that's not the story. The story is underneath the price. It's in the vaults that are emptying, in the refineries that can't keep pace, in the industrial orders that are being delayed, in the sovereign buyers who are no longer selling. This is how it always starts. Stability on the surface, rigidity underneath. And the moment you realize the system lost its flexibility, you're already inside the break. And the danger wasn't in the price, it was underneath it. If this walk through financial history sharpens how you see risk, liking the video quietly tells the system this work matters. Now, let's go back. Imagine a metal so useful that civilization can't function without it, and so undervalued that most people think of it as jewelry. Silver. Not gold's little brother, not a speculative commodity. A dual-function asset that lives in two worlds at once. One foot in the vault, as money, as insurance, as the hedge against system failure. One foot in the factory, wired into solar panels, semiconductors, medical devices, missile guidance systems, 5G infrastructure. You cannot build a modern economy without it. You cannot hoard it without breaking supply chains. And for decades, the world pretended this tension didn't exist. Governments sold it. Miners underproduced it. Industrial users assumed it would always be available, at reasonable prices in unlimited quantities whenever demand required. That assumption was never tested. Until now. Because in January 2026, something structurally different is happening. China is no longer exporting. Western vaults are no longer restocking. Industrial orders are being delayed, not because of logistics, but because physical metal isn't available at quoted prices. The COMEX futures market says silver is trading at $109. The physical premium in Shanghai says it's worth $13 more. That gap, that's not arbitrage. That's the market telling you the paper price and the real price have quietly separated. And when that separation becomes permanent, when the people who need the metal can no longer get it at the price the exchange says it should cost, the entire pricing mechanism collapses inward. This is the phase people miss, not the crash, the tightening before the crash. Well, let's go back to 1980. Silver hits $50 per ounce. The Hunt brothers try to corner the market. They fail. The price collapses. And the financial world learns a lesson. Silver is too abundant to manipulate. Regulators step in. Position limits are imposed. Futures markets are restructured to prevent hoarding. The message is clear. There will always be enough supply to satisfy demand. Except that wasn't a fact. It was a policy assumption. And for 40 years, it held. Why? Because the entire system was designed around one belief. Industrial users would never compete with investors for the same metal. Think about that. When Boeing needs aluminum, they don't compete with ETF buyers. When Tesla needs lithium, they don't bid against sovereign wealth funds in a spot market. But silver? Silver is different, because it's both a monetary asset and an irreplaceable industrial input. And the system was designed as if those two demand sources would never collide at the same time. For decades, they didn't. Investors bought when markets crashed. Industry bought when manufacturing expanded. They traded off, they took turns. The price moved, but supply always adjusted. Miners ramped production when prices spiked. Governments released reserves when shortages appeared. Scrap recycling filled the gaps. The system worked because it had flexibility. But here's what changed, slowly, quietly. In ways most analysts never priced in, flexibility started disappearing. In 2015, China begins stockpiling silver for strategic reserves, not for investment, but for technology independence. In 2020, solar panel production explodes. Each panel requires 20 grams of silver, non-negotiable. No substitute exists at scale. In 2022, inflation fears drive institutional investors into precious metals. They don't sell during corrections, they hold. In 2024, Western banks begin unwinding short positions in silver futures, not because they want to, but because physical delivery requests are increasing. and they can't source metal fast enough to meet obligations. And in 2025, the paper market and the physical market begin to price differently, not catastrophically, just persistently. A $3 premium here, a delayed shipment there, an unexplained tightness in London vaults. Nobody panicked because the price kept moving, the futures market kept trading, everything looked liquid. But liquidity and flexibility are not the same thing. Liquidity means you can trade the asset. Flexibility means the system can absorb shocks without breaking. And by January 2026, the silver market had liquidity, but no flexibility left. One assumption, that industrial and monetary demand would never collide, had quietly been violated, and no one rewrote the models. Let's talk about what success looks like when the structure is tightening. 2024 to early 2025. Analysts celebrate. Mining stocks surge. ETF inflows accelerate. Everyone agrees silver is finally getting the respect it deserves. And they're right. But here's the unintended consequence no one is tracking. Every dollar the price rises, industrial users start hoarding. Not because they're speculating, because they're terrified of supply disruptions. If you're a solar manufacturer and silver just jumped 50% in 18 months, you don't wait for the dip. You lock in contracts, you forward buy, you build inventory. And if you can't get physical delivery at spot price, you pay the premium, because not having silver means your factory shuts down. This is called demand inelasticity, and it's the quiet nightmare of every commodity market. Because when buyers can't reduce consumption in response to higher prices, the market loses its release valve. Normally, when prices spike, we can sell. Speculators take profits. Demand softens. The system rebalances. But in 2025 through early 2026, nobody is selling. Sovereign buyers aren't selling. They're building reserves. ETF holders aren't selling. They're hedging dollar risk. Industrial users aren't selling. They're securing supply for 2027 production. And the miners, they're producing flat. No new mega projects, no major discoveries. Ore grades declining. Energy costs rising. The largest silver-producing nations, Mexico, Peru, China, are seeing output stagnate or fall. In China, the world's largest refiner stopped exporting in late 2025. Not because of sanctions, because Beijing decided that silver is a strategic asset and domestic demand takes priority. Let that sink in. The country that refines 20% of global supply just exited the export market. And the COMEX futures price, it's rallied to $109. But here's what matters. That $109 doesn't reflect the cost of actually getting physical metal. In Shanghai, you're paying $122. In Mumbai, premiums are running 12 to 15%. In London, vault withdrawal requests are being delayed by 6 to 8 weeks. Why didn't the COMEX price explode proportionally? Because the futures market isn't a supply market. It's a price discovery mechanism. And price discovery only works when the people setting prices have access to the underlying asset. But in January 2026, the people trading silver futures can't source physical silver at the prices they're quoting. Refineries are backordered. Vault inventories are falling. Premiums in Asia are $13 above COMEX. And the paper market? Still trading. Still liquid. Still pretending everything is fine. This is what deferred risk looks like, not chaos. Temporary stability built on top of a structure that can't absorb another shock. The price improved. The plumbing tightened. And no one updated the risk models. Because the price said everything was working. The crack. Early warning signs. 11/14/30. Pay attention to this part, because this is where the data starts whispering, and institutions start ignoring. December 2025. The Shanghai Gold Exchange reports a persistent premium on physical silver delivery, not a one-day spike. A sustained structural gap between paper price and physical cost. $8 per ounce, then $10, then $13 by late January 2026. In a normal market, arbitrageurs would close that gap instantly, buy on COMEX at $109, sell in Shanghai at $122, pocket the spread. But they're not. Why? Because they can't get the metal. COMEX allows cash settlement. You can trade the contract without ever touching physical silver. But if you want the metal, if you request delivery, you join a line. And that line is getting longer. In January 2026, registered COMEX silver inventories fall below 45 million ounces. Sounds like a lot. It's not. That's roughly 55 days of global industrial demand. If every solar panel factory, every electronics manufacturer, every medical device company that needs silver tried to source from COMEX at the same time, The entire registered inventory would be gone in under 2 months. But again, the price doesn't panic. It climbs methodically. $102, $106, $109. Analysts call it a safe haven rally, driven by Middle East tensions and Iran-US conflict risk. And they're partially right, but they're missing the structural signal underneath. The market isn't just pricing in war, it's pricing in the loss of supply flexibility. Here's the inconvenient data most people skip. If you have a calculator nearby, open it. Global silver production, approximately 880 million ounces per year. Industrial demand, 575 million ounces, up from 560 due to solar expansion. Investment demand, 250 million ounces, up due to Iran tensions and monetary hedging. Jewelry, silverware, other, 80 million ounces. Total demand, 905 million ounces. Production, 880 million ounces. Deficit, 25 million ounces. But wait, that's before adjustments. Now add, China stops exporting refined silver, minus 130 million ounces from available supply. India raises import duties, reducing scrap recycling flows, minus another 25 million ounces. Western refineries operate at 90% capacity due to energy costs and labor constraints, minus 45 million ounces effective throughput. And industrial users forward buy an extra 12% to hedge 2027 supply risk, plus 70 million ounces additional demand. Do the math. Available supply to non-Chinese buyers, 680 million ounces. Demand from non-Chinese buyers, 975 million ounces. That's not a tight market. That's a structural deficit of 295 million ounces, with inventory buffers at 15-year lows. And the COMEX futures market is still pricing silver as if supply will adjust, because that's what it always did. In 1980, it adjusted. In 2011, it adjusted. In 2020, it adjusted. But this time, the system has no flexibility left. The mines can't ramp faster. The refineries are maxed. The vaults are being drained. And the institutions shorting silver futures, the banks that have spent decades profiting from selling paper contracts, are now facing a terrifying possibility. Delivery requests they can't fulfill. This is the crack, not in the price, in the assumptions underneath the price. The breaking point, the decision that sealed it, for 1730. Let's identify the exact moment the outcome became inevitable. It wasn't a crash. It wasn't a war. It was a policy decision that seemed completely reasonable at the time. November 2025. The COMEX, facing rising delivery requests and falling registered inventories, announces a rule change. They increase the cash settlement incentive for futures contracts approaching delivery. Translation: if you hold a silver futures contract and request physical delivery, COMEX can now offer you a cash payout at a premium to convince you to not take the metal. The rationale? Reduce strain on the physical delivery system, protect market stability, prevent a disorderly unwind. On paper, it makes sense. In practice, it's an admission that the exchange can't source enough metal to meet its obligations, and the market knows it. Within 2 weeks, physical premiums in Asia jump another $5. Why? Because sophisticated buyers now understand COMEX is no longer a reliable source of physical silver. It's a price discovery mechanism, but if you actually need the metal, you have to go elsewhere. And elsewhere is getting expensive. Fast. By early January 2026, London vaults report net outflows for the 4th consecutive month. Perth Mint in Australia delays certain deliveries to 10 and 12 weeks. Swiss refineries quote 9-week lead times, up from the usual 2 weeks. And industrial users start bypassing futures markets entirely, negotiating direct supply agreements with miners at prices well above spot. Reports emerge of solar manufacturers paying out $115, $120 per ounce in direct purchase agreements, while COMEX trades at $190. This is the breaking point, not because the system collapsed, because the system revealed it was never designed to handle simultaneous monetary and industrial demand at scale. For 40 years, silver traded as if it was abundant, as if supply was elastic, as if the futures market could always deliver. But those assumptions were only true when demand sources took turns. Investors or industry. Never both. Never at the same time. Never in a world where sovereign nations are hoarding. Green energy is non-negotiable. Inflation is persistent. Iran-US tensions threaten energy choke points. And the dollar's reserve status is being actively contested. The decision to prioritize cash settlement over physical delivery was reasonable, pragmatic, designed to prevent panic. But it also confirmed something far more dangerous. The price is no longer real. The COMEX quote is what traders agree silver is worth. but the physical premium is what buyers actually pay. And when those two numbers separate permanently, when the paper market and the real market are pricing different assets, one of them will break. History says it's always the paper. Let's talk about what happens next. Not predictions, consequences. When a commodity market loses pricing integrity, and when paper and physical separate, power shifts away from exchanges, away from banks, away from the institutions that controlled price through leverage, and toward the entities that control supply through possession. In this case, China, Russia, sovereign wealth funds, mining companies with operational reserves, and anyone who bought physical before the premiums exploded. Here's what that looks like in practice. China stockpiled silver for 7 years, while Western analysts dismissed it as irrelevant. They now hold an estimated 35,000 metric tons, enough to supply their domestic industrial needs for over 2 years without importing a single ounce. Russia has been quietly accumulating precious metals since 2014, treating silver as part of a broader de-dollarization strategy alongside gold and other hard assets. India, despite import duties, continues absorbing physical silver for cultural and industrial use, and has no intention of selling during volatility. Meanwhile, Western banks that have been short silver futures for years are now facing margin calls and delivery obligations they can't meet without sourcing metal at premiums that erase decades of trading profits. Industrial manufacturers in Europe and North America are discovering that their supply chains, built on just-in-time delivery and spot pricing, are no longer functional in a world where metal has to be secured months in advance at prices 10-15% above exchange quotes. And investors who bought silver ETFs are starting to ask uncomfortable questions. Does this fund actually hold the metal? Or is it a claim on metal that might not exist? Can I actually redeem for physical if I need to? This is not conspiracy. This is structural consequence. When supply tightens and premiums explode, the difference between owning metal and owning a contract becomes existential. The people who absorb the cost? Industrial users who can't pass price increases to consumers. Manufacturers who face production delays or outright shutdowns. Retail investors who bought paper exposure and discovered it wasn't the same as physical ownership. Small solar installation companies that can no longer afford panels. The people who benefited? The sovereign buyers who accumulated early and quietly. The miners who locked in long-term supply contracts at premium prices. The refineries that control bottleneck capacity and can now dictate terms. And the physical holders who secured metal before the premium structure changed. And here's the deeper shift. This isn't just about silver. This is about what happens when a critical commodity market, one that underpins green energy, defense technology, and monetary hedging, transitions from elastic to inelastic, from flexible to fragile, from liquid to locked. Because once the premium becomes structural, and once physical buyers stop trusting paper prices, the entire commodity complex starts repricing risk differently. Copper, lithium, cobalt, rare earths, any material where supply is concentrated. Demand is non-negotiable, and futures markets have been used to suppress price volatility for decades. The signal from silver is this: the era of infinite leverage and elastic supply is ending. The era of physical control and strategic hoarding has begun. And the institutions that built their models on the old system, they're not ready. If understanding how institutional leverage quietly collapses helps you position differently, consider subscribing, not for predictions, but for the frameworks that reveal when structures are tightening before prices reflect it. Let's bring this forward. January 26th, 2026. Silver is trading at $109. Tensions between the US and Iran are at crisis levels. The Strait of Hormuz, through which 20% of global oil transits, is under active threat. Analysts are calling this a safe haven rally, and they're not wrong, but they're incomplete. Because the fear driving silver right now isn't just geopolitical, it's structural. Let me show you what's happening beneath the headline. If Iran closes or significantly disrupts Hormuz, even temporarily, energy costs spike globally. Higher energy costs mean higher mining costs. Silver extraction is massively energy intensive. Higher refining costs. Smelting requires enormous electricity consumption. Higher transportation costs, moving metal from Mexico, Peru, and remaining export nations to global markets. In other words, the cost floor for producing silver rises, just as industrial demand is surging and physical supply is already in deficit. Now layer in, the US government faced shutdown risks in recent weeks. Tariff wars continue disrupting supply chains. The dollar is under sustained pressure from BRICS nations exploring commodity-backed currency alternatives. China, the world's largest silver refiner, has made it explicitly clear domestic demand takes absolute priority. This is not a single shock. This is compounding fragility. And here's why that matters. When silver hit $50 in 1980, it collapsed because supply was elastic. Miners ramped production aggressively. Governments released strategic reserves. Scrap flooded the market from jewelry and silverware. The Hunt brothers couldn't sustain the squeeze. But in 2026, supply is not elastic. Mines are producing flat or declining. Governments have minimal reserves left after decades of sales. Scrap recycling is constrained by refinery capacity bottlenecks, and the entities buying, sovereign nations, industrial giants, strategic funds, are not selling. So when the price moves now, it's not speculative froth. It's real demand meeting structural shortage in a system with no release valve. And the risk isn't that silver crashes back to $80. The risk is that it locks, or that the premium becomes so high, so persistent, that industrial users can't afford to build, that green energy projects get delayed because solar panels require silver, and silver isn't available at any rational price, that the futures market becomes irrelevant because no one trusts paper prices anymore. This has happened before, not in silver, in other markets. Palladium in 2000. Russia controlled primary supply. Automotive manufacturers needed it desperately for catalytic converters. No substitute existed. The price went from $200 to $100 in 18 months. Not because of speculation. Because there was no substitute and no flexibility. Rhodium in 2008, tighter emission standards created inelastic demand, South African supply dominance. Limited above-ground inventory, price spiked from $1,000 to $10,000. Manufacturers had no choice but to pay. Silver is bigger than both, more essential, more politically sensitive, more widely needed across more industries. And the structural deficit is worse than either of those precedents. Prices are the headline. Plumbing is the story. The headline says silver is rallying to $109 on Middle East tensions and safe haven flows. The plumbing says COMEX inventories are at 15-year lows. Physical premiums are widening to $13.15. Industrial orders are being delayed 8 to 12 weeks. Sovereign buyers are hoarding aggressively. And the futures market is quietly losing credibility among physical users. That's not a rally. That's a market in transition, from price discovery to price disconnection. And when that transition completes, when physical and paper fully decouple, the consequences won't be a crash. There'll be chaos in the real economy, because you can't build solar panels with a futures contract. You can't wire semiconductors with an ETF share. You can't manufacture medical devices with leverage. You can't build missile guidance systems with paper silver. You need the metal. And if the metal isn't available at any price the market considers reasonable, the projects don't get built. The factories don't run. The supply chains break. The green energy transition stalls. Defense contractors face material shortages. This is the implosion risk no one is pricing. Not a financial implosion. A structural implosion, where the commodity market stops serving its actual function, delivering the commodity, and becomes a pure speculation engine disconnected from physical reality. History doesn't repeat events. It repeats incentives. And right now, every incentive is pointing the same direction. Hoard physical. Secure supply far in advance. Don't trust paper claims. Don't wait for dips that may never come. Don't get caught without the metal when the system locks. That's not a prediction. That's the rational response to a market where flexibility has been systematically removed and no one updated the risk models. The Iran-US situation could escalate further. It could de-escalate temporarily. The price could hit $120. The price could correct to $95 if tensions ease. I don't know. Nobody does. But what I do know is this. The structure is tighter than it's ever been in modern history. The flexibility is gone. The assumptions are outdated. The gap between paper price and physical reality is widening daily, and the number of entities that can actually deliver physical silver at exchange prices is shrinking. That doesn't guarantee a specific price outcome, but it guarantees extreme volatility, and it guarantees that when the system breaks, it will break faster and harder than any model predicts. Because the models were built for a market that had room to adjust. This market doesn't. Not anymore. Let's step back. What is this really about? Two things. First, about systems. Markets don't fail because of crashes. They fail because the assumptions they were built on quietly stop being true, and no one notices until the structure can't bend anymore. Silver was designed to be abundant, elastic, always available. For 40 years it was, but the world changed. Green energy made it non-negotiable. Sovereign competition made it strategic. Monetary instability made it a hedge. Geopolitical conflict made it vulnerable. And the system, the futures exchanges, the pricing models, the supply agreements, never adapted. It kept pricing silver as if the old rules still applied, as if industrial and monetary demand would never collide, as if supply would always adjust, as if China would always export, as if peace would always prevail. It won't. And the longer the market pretends otherwise, the more violent the adjustment will be when reality forces the reset. Second, about human behavior. We are wired to trust prices. If silver is trading at $109, we assume that's what it's worth. If COMEX says there's liquidity, we assume we can access it. If the headlines say safe haven rally, we assume that's the whole story. But prices are just signals, and signals can lie, especially when the infrastructure behind them is breaking. The smartest traders don't watch prices. They watch plumbing. They watch inventory levels. They watch premiums. They watch delivery times. They watch who's buying and who can't sell, because that's where the real risk lives, not in the chart, in the assumptions underneath the chart. So here's what you take from this. Silver might hit $120. It might hit $150 if Iran closes Hormuz. It might correct back to $95 if tensions ease temporarily. I don't know. Nobody does. But what I do know is this. The structure is tighter than it's been in modern market history. The flexibility is gone. The assumptions are outdated. The gap between paper price and physical reality is widening. And the system's ability to deliver physical metal at exchange prices is deteriorating. That doesn't guarantee a specific outcome, but it guarantees volatility. And it guarantees that when the system breaks, it will break faster and harder than the models predict. Because the models were built for a market that had room to adjust, a market where supply was elastic, where demand sources took turns, where governments had reserves to release, where China was an exporter, where the futures market actually delivered. This market has none of those things. Not anymore. If this helped you see the system more clearly, if it sharpened how you think about risk, about structure, about the difference between price and plumbing, consider liking this video and subscribing to the channel. Not for predictions, for perspective, because the next crisis won't announce itself with a headline. It will whisper in the data, in the inventories, the premiums, the delayed shipments, the widening gaps, long before the price admits something is wrong. And by the time the price catches up, you're already inside the break.